soon I would see financial Armageddon with housing as its trigger point. Now, in predicting when and how the collapse would occur, my focus was again on the actions of our government and the response of the private sector. This was much in keeping with my studies a decade earlier in Chicago.
Michael Burry, the intelligent guy from The Big Short, is well known for predicting the 2008 housing market crash, known as the housing bubble, and the global financial crisis. Well, now, he's saying there's another stock market bubble and inflation crisis coming in 2023. So what's his advice for investing in these uncertain times? And how should beginners navigate the stock market with all this going on? This video will uncover all of this and more. Michael Burry is an American physician, hedge fund manager, and investor. He's the founder and chief investment officer of Scion Asset Management, a hedge fund he started after closing his previous hedge fund, Scion Capital, which he managed from 2000 to 2008. He's perhaps best known for correctly predicting the subprime mortgage crisis and profiting from it, as chronicled in Michael Lewis's book The Big Short and the subsequent film adaptation of the same name. Before his career in finance, Burry received an MD, along with a BS in economics from Vanderbilt University, and he practiced as a neurologist for several years. He made a ton of money by buying credit card default swaps and even got featured in Michael Lewis's book The Big Short. He was played by Christian Bale in the movie Adaptation. I hope you've watched the movie. At the end of the film, he said he doesn't invest anymore and is only focused on the water industry. That sounds funny, but, well, he's back in the stock market game and even started his own fund, Scion Asset Management. You might not know this, but even though he's not giving interviews or doing podcasts, you can still follow his thoughts and opinions on the stock market through his Twitter account. And you won't believe this, but his Twitter handle is Cassandra. I know, it's a funny name, but that's the real guy. That being said, the goal of this video is to give a summary of Michael Burry's recent views on topics such as investing, inflation, and the overall state of the markets. I want you to understand his advice and what he has to say about these matters for the year 2023. So, what's Michael Burry's take on the current state of the stock market? Well, like many other smart investors, he thinks that the U.S. market is really hot right now. In fact, he's publicly stated that he believes there are a lot of overvaluations going on. In November, he said that there's more speculation happening now than there was in the 1920s. There's more overvaluation than in the 1990s. And there's more economic and geopolitical issues than in the 1970s. One way to see this overvaluation is by looking at the Shiller P/E ratio, which is like a big P/E ratio for the whole market. The higher the number, the more expensive the market is. Right now, the Shiller P/E ratio is at 36, which is really high compared to the average of 16 or 17. And that's even taking into account that the S&P 500's earnings went up a lot last year. With all this in mind, it's not hard to understand why Burry is so confident in his predictions. In an email interview from 2019, Michael Burry discussed the idea that ETFs were in a bubble and explained why it made sense. He stated that low interest rates were leading to large amounts of money being flooded into the stock market, and with the growing popularity of passive investing, money was pouring into the top 500 companies in America, regardless of their individual performance. This type of investing can lead to bubbles forming when stock prices are no longer based on company fundamentals. However, he also mentioned that he was still able to find value in international markets, specifically in Japan, where he found companies with low earnings multiples or low free cash flow multiples, and some of these companies also had significant cash or stock holdings that made up a large portion of their stock prices. Burry does not believe that the current state of the U.S. economy is dire, but he does think that investment opportunities are limited. He feels that the situation is becoming increasingly difficult for all types of investors, whether they take a passive or active approach. Burry suggests that investors should look for opportunities outside of the U.S., as the market conditions may not be currently favorable. This advice aligns with what other prominent investors, such as Monish Pabrai, Charlie Munger, and Ray Dalio, have also been stating. It's important to note that when looking for international investment opportunities, it's crucial to have a good understanding of the analyzed businesses. Additionally, inflation is also a significant concern for 2023. Michael Burry strongly believes that inflation will significantly increase within the following year. He made this prediction in February 2021, stating that the government's actions such as printing a large amount of money and reopening businesses will cause inflation to rise. He also mentioned that employee and supply chain costs will contribute to this increase. When he made this prediction, the annual inflation rate in the U.S. was 1.7%, but it has since risen to 6.5%. So he was spot on with his prediction, wasn't he? It's amusing because he seems to be aware of this as well. He had tweeted earlier in November that inflation is not just due to the reopening of the economy. It's like he foretold this. Burry discussed inflation throughout the year last year and also acted on it by making a bet against the 20-year U.S. Treasury bonds. This is because when inflation increases, the Federal Reserve intervenes by increasing interest rates to bring it down. Bond prices decrease as interest rates rise. Thus, Burry made a bet on the iShares 20-year Treasury bond ETF. Whatever it was, it turned out to be right. But because the Fed didn't take action early, the trade probably didn't make him any money. He has since abandoned those bets against the bonds, but that bet and his recent tweets make it clear that he's anticipating inflation to persist, and more importantly, that he's expecting the interest rates to increase. According to Burry, we should be prepared for the possibility of seeing some significant increases in interest rates in the next year or so if inflation continues to rise. We need to be mentally ready for this and make sure that we're not going to be negatively affected by any loans we have, as the interest payments could become more expensive. Also, we should be aware of the possibility of bond prices falling or the stock market coming under a lot of pressure. So, that's what we can take away from Burry's current thesis on inflation. According to Michael Burry, the key to his success as a stock picker is research. He's not limited in the types of companies he invests in and is open to any opportunities that present themselves, regardless of market conditions. Burry also has a preference for companies that are currently out of favor, as he believes they offer the best chances to buy shares at a discounted price. In addition, he also seeks out companies with a sustainable competitive advantage, similar to those favored by Warren Buffett, if they're available at a good price. However, these types of investments are harder to come by, and he views them as longer-term opportunities. He is a value investor and uses Benjamin Graham's concept of margin of safety as a key factor in his investment decisions. This strategy involves buying assets whose intrinsic value is greater than the final purchase price, with the expectation that the asset will eventually reach or exceed its inherent value in the medium or long term, similar to purchasing a product at a discounted price. Warren Buffett also uses this concept in his investment strategy. The idea behind this approach is to minimize risk by ensuring that there's a significant difference between the final price and the intrinsic value of an asset, which is known as the margin of safety. Burry believes that it's crucial to understand a company's value before investing. His primary objective is to protect his downside risk to prevent a permanent loss of capital. Therefore, his entire stock-picking process is based on the concept of the margin of safety. This means that he only invests in companies whose intrinsic value exceeds their final purchase price so that he can minimize the risk of losing money. By focusing on the margin of safety, Burry aims to ensure that he's protected against market fluctuations and other potential risks that could cause a permanent loss of capital. When evaluating a stock, Michael Burry follows a specific process to determine a specific price and value for a company. The first step is to ensure that the stock meets the initial criteria of the margin of safety. Once these initial criteria are met, Burry conducts a more detailed analysis of the company's financials. This process includes evaluating the company's true free cash flow, which is the amount of cash generated by the company's operations that is available for reinvestment or distribution to shareholders. Burry also takes into account off-balance sheet items, which are financial obligations that are not reflected on the company's balance sheet. These items can include long-term leases, pension obligations, and other contractual obligations that can have a significant impact on the company's financial health. Burry doesn't pay attention to price-earnings ratios, which are used to evaluate a company's current share price concerning its earnings per share. He believes that return on equity, which measures a company's profitability by comparing its net income to its shareholder equity, can be misleading and risky. Instead, he prefers companies with minimal debt and a strong balance sheet. He also looks for special situations, such as rare birds, which include companies with unique opportunities such as asset pays, arbitrage opportunities, and companies trading at less than 2/3 of their net value. These special situations can provide significant value to investors and can be found through thorough research and analysis of the company's financials, industry trends, and economic conditions. Not only is Michael Burry a legendary investor, but he's also known for his unique approach to stock market analysis. He emphasizes the importance of the margin of safety and thoroughly evaluates a company's accurate free cash flow and off-balance sheet items. He also believes in minimizing debt and looks for special situations, such as rare birds, to find hidden value. As we look toward a lucrative 2023, it's clear that following in Burry's footsteps could be a wise investment strategy. By focusing on a company's true financial health, looking for special opportunities, and minimizing debt, investors can potentially find hidden gems in the stock market. Of course, as with any investment, it's important to conduct your own research and consult with a financial advisor before making any decisions. But if you're looking for a tried-and-true method for success in the market, following the principles of Michael Burry is a great place to start. If you found this video valuable, be sure to check out our video about how to make money during inflation by Warren Buffett. And editing these videos for you takes loads of time and dedication. It would be great if you rewarded us by hitting the like button and subscribing to our channel.